I get this question all the time from business owners, and they're wondering if they should incorporate a holding company into their corporate structure. I would say 9.5 times out of 10, the answer is yes. Depending on the industry, some industries have certain rules on can holding companies own shares of operating companies or professional corporations, things like that. But generally speaking, there are ways to incorporate a holding company into your corporate structure, and I'm going to show you why. So most business owners have the OpCo, the operating company, and they're generating revenue into the OpCo. Now in Ontario, the tax rates are 12.2% on any income that is below $500,000, any net income, and it's only 26.5% on net income that is above $500,000. So that's a good thing. The corporate tax rates in Ontario are favorable compared to personal marginal tax rate system. But the thing is, if you are generating income in your operating company, you may be putting yourself offside for what's called the lifetime capital gains exemption. So the LCGE, as of 2024, is finally over $1 million. It's actually $1,016,836. So you want to make sure you qualify for this if you ever do sell your company. So if your company is sellable, or if there's a potential sale in the future, you want to make sure you're purifying your operating company and not putting yourself at risk to not qualify for the LCGE. Now, the CRA outlines very specific rules on how to qualify for the lifetime capital gains exemption. The first being what's called a 24-month holding test. And that means that the owner of the shares needs to own the shares for at least 24 months prior to sale. So you can't issue new shares tomorrow and all of a sudden use the lifetime capital gains exemption. There needs to be a 24-month ownership period. There's also something called a 50% asset test. And what that means is at least 50% of the assets in the operating company for 24 months prior to sale need to be considered active business assets. So you can't have passive assets in the OpCo, which could be properties, it could be the certain life insurance policies, it could be a stock portfolio, it could even be too much cash. So owning too much cash in the OpCo could actually throw you offside. So that's something to consider. And then there's also what's called a 90% test. And this means at point of sale, at least 90% of the OpCo's assets need to be considered active business assets. So the reason the holdco helps you qualify for this is you have the holdco over here, you set it up, and the holdco will have ownership in the OpCo, and you can now transfer intercorporate dividends from OpCo to holdco completely tax-free, and you'll accumulate all your profits in the holdco and purchase all of your assets in the holdco, not the OpCo. So in the holdco, once you're transferring money in there, you're going to purchase all of your real estate, you're going to purchase your stock portfolios, you're going to have your life insurance policies in the holdco, and then just cash as well. You can have multiple shareholders off the holdco, and you can even implement a trust. The holdco could be a beneficiary of the trust, or the trust could have some ownership in the OpCo. You can play around with the structure. But most importantly, you're purifying the OpCo. You're going to sell the business in the future at some point, but you're going to keep this for the rest of your life. So you're separating what is considered like non-active assets versus active assets. Because if you own properties and stock portfolios and just too much cash in the OpCo and you sell the company one day, you do not want to be in a situation where you're liquidating assets out of the corporation and triggering pretty significant tax bills for yourself when you could have just structured it a little bit more appropriately from the beginning. So if you are a business owner and you do have just an operating company, most likely you do want to look at incorporating a holding company into your corporate structure.